Affirm Holdings, Inc., the buy now, pay later platform, enabling consumers to split purchases into honest installments across 330,000 merchant partners with no hidden fees or compounding interest.
AFRM generated $3.2 billion in FY 2025 revenue at 50% gross margin, growing 39% as the Affirm card expanded buy now, pay later beyond merchant checkout to any point of sale.
The story begins in 2012. Max Levchin co-founded Affirm in San Francisco after co-founding PayPal. The mission: transparent installment loans with no hidden fees or compounding interest.
Affirm IPO'd on NASDAQ in January 2021 at $49 per share, raising $1.2 billion as buy now, pay later became the defining consumer finance trend. The stock doubled on the first day.
In 2023, Affirm launched the Affirm Card, a physical debit card letting cardholders split any purchase into installments after checkout. By 2025, active cardholders reached 4.4 million.
Interest income and gain on loan sales generates 55% of revenue. Merchant network fees, paid by retailers for checkout conversion, contribute 45%, plus interchange on the Affirm card.
Amazon, Shopify, and Walmart anchor Affirm's merchant network alongside 330,000 active partners. Affirm's fiscal year ends June 30th, making the most recent reported quarter fiscal Q3 2026.
FY 2025 revenue reached $3.2 billion, up 39%, with gross margins at 50%. Affirm reached GAAP profitability in FY 2025, posting net income of $52 million.
Fiscal Q3 2026 delivered $1.0 billion in revenue, up 33%. EPS of 30 cents beat 17 cents estimated. GMV reached $11.6 billion, up 35%.
PayPal's Pay Later and Venmo installments are the primary embedded BNPL competitor, with 400 million users as distribution. Affirm's no hidden fee model and merchant-funded underwriting differentiate on consumer trust.
Klarna, filing for a U.S. IPO, competes on European merchant reach. Block's Afterpay targets fashion merchants. Neither has Affirm's direct integration depth with Amazon, Shopify, and Walmart.
Affirm's moat is honest underwriting. No compound interest, no late fees, no hidden charges. The Affirm card extends that trust to any merchant, capturing purchase intent beyond the integrated network.
Affirm's primary market is the United States, 330,000 active merchant partners anchored by Amazon, Shopify, and Walmart. The Affirm card's 4.4 million users extend BNPL to any point of sale.
Canada is an active secondary market. Cross-border e-commerce drives adoption. International presence is limited today. Near-term growth is U.S.-focused, scaling direct-to-consumer GMV through the Affirm card.
Max Levchin co-founded Affirm in 2012 with a single mission: build financial products that are honest to consumers. He co-founded PayPal in 1998 and sold Slide to Google before Affirm.
Levchin built PayPal's fraud detection from 1998 to 2002, then co-founded Slide and joined Google as VP of Engineering. That underwriting depth is the foundation of Affirm's risk model today.
Affirm, the buy now, pay later platform, $3.2 billion in FY 2025 revenue, with the Affirm card and direct-to-consumer GMV as the compounding growth layers beyond merchant checkout.
Fiscal Q3 2026 beat on both lines, $1.0 billion in revenue, up 33%, and EPS of 30 cents versus 17 cents estimated. Full-year revenue guidance raised to $4.2 billion.
Affirm just posted its first GAAP profitable quarter ever. GMV grew 35% year over year to $8.6 billion. They raised full-year guidance. Today we break down what this inflection means.
I'm Lana Hudson. This is Charged Alpha, the S&P 500 earnings encyclopedia, ticker AFRM, Affirm Holdings, Q1 2026. The GAAP headline is distorted. We're going straight to the number that matters.
Here's the snapshot. GAAP revenue came in at $268 million. On the surface, that looks like a 66% decline year over year, but that comparison is meaningless. Q1 2025 was artificially inflated by hundreds of millions in non-cash fair value gains on loans. The real number is GMV $8.6 billion, up 35%. EPS was 31 cents per share on a GAAP basis, beating the consensus estimate of 24 cents.
So EPS beat by 7 cents, nearly 30% above consensus. The stock is trading around $42, sitting well below its 52-week high of $72.50. Analyst consensus target is $52, implying roughly 24% upside from here. Before we go deeper, Hudson, explain why GAAP revenue is essentially irrelevant for Affirm.
Affirm's GAAP revenue includes fair value adjustments on loans it holds on its balance sheet. When loan values spike, as they did in Q1 2025, GAAP revenue balloons. When they normalize, it collapses. Neither figure represents how many transactions Affirm processed or what it earned from operations. GMV, gross merchandise volume, is the real metric. Consumer purchases financed through the network, $8.6 billion this quarter.
On the income statement, the headline numbers are significant. Operating income was $88.4 million, positive for only the second time in company history. Net income was $102.9 million, also GAAP positive. Gross margin was approximately 60%, consistent with Affirm's network revenue structure, where they earn fees from merchants and interest from borrowers net of funding costs.
The operating margin came in at 33% on reported revenue. That's exceptional for a lending-adjacent fintech. It reflects significant operating leverage. As GMV scales, fixed costs spread across a larger transaction base. Affirm's cost structure includes technology infrastructure, credit decisioning, and consumer acquisition. But as Shopify and Amazon funnel transactions through the platform, the incremental cost per dollar of GMV keeps declining.
The guide raise is the part the market should care about most. Management raised full-year GMV guidance above the prior range, a signal that they see Q1's strength as durable, not a one-quarter anomaly. In a sector that has faced persistent skepticism about the long-term viability of BNPL, a guide raise alongside first GAAP profitability is a powerful combination.
The 5-quarter EPS progression is what the turnaround looks like in practice. Q1 2025, negative 21 cents. Q2, negative 31 cents. Q3, negative 15 cents. Q4 2025, positive 10 cents, the first turn. And now Q1 2026, positive 31 cents. The trajectory is steep and consistent, each quarter bringing the company closer to full profitability, and Q1 2026 confirming the inflection is real.
The EPS beat matters strategically. Analysts expected 24 cents, Affirm delivered 31. That 7-cent beat represents real earnings power the market hasn't fully priced. With GAAP profitability now demonstrated alongside 35% GMV growth, the valuation case is considerably stronger than it was 6 months ago.
Here's the bull case. Start with the enterprise flywheel. Affirm is embedded directly in the checkout flow at Shopify and Amazon, two of the largest e-commerce platforms in the world. Every time Shopify onboards a new merchant, every time Amazon adds a new product category, Affirm gains distribution without paying for it incrementally. That's compounding leverage on a network that already processes $8.6 billion per quarter.
The 0% APR product is the consumer loyalty driver that skeptics underestimate. When Affirm offers an installment plan at 0% interest on a large purchase, the consumer gets a genuinely better deal than any credit card. That experience creates repeat usage, and repeat usage is what converts a BNPL transaction into a durable customer relationship with lifetime value across dozens of future purchases.
The profitability inflection is the third pillar. Affirm has spent years investing in underwriting technology and building its merchant network. Q1 2026 demonstrates that the fixed cost investment phase is over and the operating leverage phase has begun. Every incremental dollar of GMV now generates positive operating income because the infrastructure is built and the unit economics are working. The guide raise suggests management agrees the inflection is structural, not seasonal.
Bull case math. If Affirm grows GMV to $40 billion by fiscal year 2027, roughly 4 quarters of 35% growth compounding, and sustains 60% gross margins with continued operating leverage, earnings power expands dramatically. At that scale, a $13 billion market cap looks extremely cheap. Analysts project EPS of $1.50 by FY 2027. which at a 28 times multiple implies a target north of $40 just on earnings alone.
The bear case starts with credit quality. Affirm is a lender, and in a recessionary scenario, consumer delinquencies rise. The BNPL model targets consumers who may not qualify for traditional credit cards, which means Affirm's loan book has higher than average sensitivity to consumer financial stress. One bad credit cycle could reverse the profitability story quickly.
Interest rates are a structural headwind. Affirm's funding costs rise when rates are high. It borrows to lend. If the Fed keeps rates elevated longer than expected, margins compress. Competition is also intensifying. Apple Pay Later, bank-issued installment plans, and Klarna are all fighting for the same checkout button placement that drives Affirm's GMV.
And the gap accounting creates a persistent transparency problem. If fair value gains return in a future quarter, revenue will spike meaninglessly again. If they reverse, revenue collapses, even when GMV is growing. Bears argue this opaqueness justifies a discount to peers with cleaner financials. At 4.8 times sales in a rising rate environment with credit risk, the valuation is not unambiguously cheap.
Let's go deeper on the credit risk. Affirm uses proprietary machine learning for loan underwriting, evaluating each transaction individually rather than relying solely on FICO scores. In benign credit environments, this has produced better than expected loss rates. But machine learning models are trained on historical data. A macroeconomic shock, rapid job losses, a severe consumer spending contraction would test whether the models hold up in conditions they haven't fully seen. Investors need to size this position knowing that downside scenarios can be asymmetric.
Competitive dynamics are evolving fast. Apple Pay Later launched with massive distribution through iPhone and the App Store. Major banks are adding installment options to existing credit products. Klarna is pursuing an IPO and investing heavily in U.S. market share. Affirm's moat is its merchant relationships and underwriting data, but as competitors match features and offer lower merchant fees to gain distribution, Affirm must continue winning on credit quality and user experience rather than network exclusivity alone.
On the balance sheet, Affirm holds approximately $2 billion in cash against $3.5 billion in total debt. That debt is primarily funding for its loan portfolio, not traditional corporate leverage. Net debt is approximately $1.5 billion, which is manageable given the asset-backed nature of the borrowing. Free cash flow on a trailing 12-month basis is approximately $400 million, enough to fund operations and support continued technology investment without diluting shareholders.
Forward estimates project revenue of $1.15 billion for full year 2026 and $1.4 billion for 2027. EPS is expected to reach 80 cents in FY 2026 and 150 by FY 2027 as operating leverage compounds. Price to free cash flow at 32.5 times is elevated but reasonable for a company growing GMV at 35% with a newly demonstrated path to profitability. Market cap at $13 billion implies a price to sales of 4.8 on reported revenue.
On options market dynamics, AFRM carries a beta of roughly 2.85, meaning it amplifies broader market moves by nearly 3 times. Implied volatility post-earnings typically spikes and then collapses, creating a window where premium selling strategies can outperform directional bets. For investors considering a position, the elevated IV environment means selling puts at a strike price you'd be comfortable owning can generate meaningful income while waiting for a better entry point.
On insider activity, CEO Max Levchin has been a consistent long-term holder of AFRM shares. No significant insider selling has been filed in recent months, which signals at minimum that leadership remains aligned with shareholders. Institutional ownership has been growing as the company approaches profitability, a pattern consistent with growth funds building positions ahead of full GAAP profitability becoming undeniable in the financial statements.
One angle worth framing for longer-term investors. Affirm's market cap of $13 billion implies it's trading at roughly 1.5 times GMV. For context, PayPal's total payment volume supports a much larger absolute market cap. If Affirm grows GMV toward 30 or 40 billion over the next 2 to 3 years while maintaining profitability, the current multiple compresses dramatically. That's the case for holding through near-term macro uncertainty.
The analyst community is broadly bullish. 8 strong buys, 14 buys, 10 holds, just 2 sells. Consensus price target of $52 implies 24% upside from 42. Recent upgrades include Morgan Stanley moving to overweight ahead of the print. The beat and raise combination today is likely to trigger additional upgrades and target increases in the coming days as the sell side updates models. This episode is for educational and entertainment purposes only. Nothing discussed constitutes financial advice or a recommendation to buy or sell any security. Charged alpha may hold positions in companies discussed. Always do your own research and consult a qualified financial professional before making any investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall